Audit planning and fieldwork. The first step of audit is acceptance of new client or continue with existing client. Governed by two standards which are ISO 220 and ISQC 1. In ISO 220, the engagement partner should be satisfied that appropriate procedures regarding the acceptance and continuance of client relationships and specific audit engagements have been followed and that conclusions reached in this regard are appropriate and have been documented. While in ISQC 1, firms should establish policies and procedures for the acceptance and continuance of client relationships and specific engagements, designed to provide it with reasonable assurance that it will not undertake or continue relationships and engagements where it 1. Has considered the integrity of the client and does not have information that would lead it to conclude that the client lacks integrity. 2. Is competent to perform the engagement and has the capabilities, time and resources so on. 3. Can comply with ethical requirements. Next, engagement letter. It is the interest of both parties and engagement letter on any form of written material should be prepared, agreed and signed by both parties once the auditor has decided to accept a client. The purpose is to help avoid misunderstandings with respect to the engagement. Engagement letter should include 1. The objective and scope of audit. 2. Management's responsibility. 3. The terms of the engagement. 4. Access to whatever information the auditor requires. 5. A request for the client to confirm the terms of the engagement. 6. Other information such as fees, client staff or other auditor deems relevant. 7. Auditor may send new letter for recurring audit if there is any material changes, fraud. According to ISO 240, the auditor's responsibilities relating to fraud in an audit of financial statements recognizes that misstatement in the financial statements can arise from either fraud or error. That distinguishing factor is whether the underlying action that resulted in the misstatement was intentional or unintentional. Fraud can be further split into two types. First, fraudulent financial reporting that deliberately misstating the accounts to make the company look better, worse than it actually is. Secondly, misappropriation of assets, which is the theft of the company's assets such as cash or inventory. The external auditor's responsibilities is for obtaining reasonable assurance that the financial statements, taken as a whole, are free from material misstatement, whether caused by fraud or error. In order to achieve this, auditors must maintain an attitude of professional skepticism. This means that the auditor must recognize the possibility that a material misstatement due to fraud could occur, regardless of the auditor's prior experience of the client's integrity and honesty. Next, reporting fraud. If the auditor identifies a fraud, they should communicate the matter on a timely basis to the appropriate level of management. If the auditor has doubts about the integrity of those charged with governance, they should seek legal advice regarding an appropriate course of action. In addition to these responsibilities, the auditor must also consider whether they have a responsibility to report the occurrence of a suspicion to a party outside the entity. Lastly, directors' responsibilities. The directors have a primary responsibility for the prevention and detection of fraud. By implementing an effective system of internal control, they should reduce the possibility of undetected fraud occurring to a minimum. Next is management assertions. It is the claims made by members of management regarding certain aspects of a business. The concept is primarily used in regard to the audit of a company's financial statements, where the auditors rely upon a variety of assertions regarding the business. The auditors test the validity of these assertions by conducting a number of audit tests. Transaction-related audit objectives. There are 6 general transaction-related audit objectives. 1. Occurrence is dealing with whether the recorded transactions have actually occurred. 2. Completeness is existing transactions are recorded. 3. Accuracy is recorded transactions are stated in the correct amounts. 4. Posting and summarization is recorded transactions are properly included in the master files and are correctly summarized. 5. Classification is transactions included in the client's journal are properly classified. 6. Timing as transactions are recorded in the correct dates. Balance-related audit objective. 1. Existence which amount stated in financial statements actually exists. 2. Competences the existing amount have been counted and included in financial statements. 3. Accuracy where the amount included in financial statement are properly classified. 4. Classification is the amount included in financial statement are properly classified. 5. Cut off is the transaction is recorded on balance sheet in proper period. 6. Rights and obligations are the items in the financial statements are owned by the client's business and industry. Firstly, industry and the external environment. There are risks associated with certain industries. The auditor must also consider the external environment in which a company operates, such as the economic situation, regulatory requirements, and other factors. Next, business operations and processes. The auditor must strive to understand how the business works, how revenue is generated, how the company is financed, who the customers are. Additionally, identifying transactions with related parties is a necessary step in understanding the business. Business risks are the factors that could prevent or hinder the achievement of organizational goals and objectives. There are a few examples of business risk. The importance of considering business risks in audit planning is: in view of the high-profile accounting scandals in recent times, the role and responsibilities of auditors has been questioned. It is in view of such scandals that the adoption of a top-down approach in auditing has been emphasized, where the auditor proceeds by gaining an understanding of the entity, its environment, significant business risks and how these risks might translate into audit risks. Analytical procedures consist of evaluations of financial information and such investigation as is necessary of identified fluctuations or relationship. There are three primary purposes. 1. Preliminary analytical reviews are performed to obtain an understanding of the business and its environment to help assess the risk of material misstatement and to help the auditor develop the audit strategy and program. 2. Analytical procedures are used as substantive procedures when the auditor considers that the use of analytical procedures can be more effective or efficient than tests of details. 3. Final analytical review. Analytical procedures are performed as an overall review of the financial statements at the end of the audit. Final analytical procedures are not conducted to obtain additional substantive assurance. If irregularities are found, risk assessment should be performed again to consider any additional audit procedures are necessary. The materiality concept is the principle in accounting that trivial matters are to be disregarded, and all important matters are to be disclosed. Items that are important enough to matter are material items. The auditor's determination of materiality is a matter of professional judgment, and is affected by the auditor's perception of the financial information needs of users of the financial statements. Qualitative factors that may cause an item to be viewed as material include whether the matter arose out of a conflict of interest or a potentially illegal act. Quantitative standards of materiality normally relate the dollar size of an item to an appropriate base amount. The aim is an attempt to establish some consistency in determining the materiality of an item. Auditors should consider materiality when: 1. Determining the nature, timing and extent of auditor procedures. 2. Evaluating the effect of misstatements,